let's rock. Litzler, how you doing, buddy?
I'm doing great, buddy. How are you?
Crazy times, man. Crazy times. There's a lot of stuff going on right now.
It is crazy times, and thanks for having me on here and speaking with you about the capital markets. And of course, want to make sure that everybody listening knows that we, wish them the best and hope everybody's social distancing and everybody's families are well. So, in a time of ever-changing environment, we want to make sure that everybody's health and safety is obviously the most important.
Appreciate that political correctness, Chris. That's nice of you. Now let's talk about the capital markets, right? Let's talk about being capitalists. All right. So as all you guys know, Chris is commercial mortgage broker, does $300 million a year in loans. And a chunk of that is my stuff, and he does all my stuff. So he is an absolute ace, works for a firm called Pinnacle Financial, who was acquired about a year and a half, 2 years ago by Marcus Millichap, and out of the Cleveland market. So if you guys need commercial money, this is the guy to go to. So Chris, dude, you know more about this stuff than everybody else combined, right? So let's talk a little bit about, obviously there's this big coronavirus scare. Everybody's spooked. There's a lot of craziness going on right now. Interest rates are dropping. People are talking about HUD not, foreclosing on mortgages and stopping all evictions and all this other stuff. So let's scale it back. And I got a couple of bullet points that I definitely want to hit on. One is I want to talk about past loans or loans that people already have on properties. And how are you seeing all of this affecting, either in a good way or a bad way, those existing loans already in place?
Sure. Yeah. And it's a great question. It's one that we've answered, frankly, over and over again this week as people are trying to prepare for what inevitably comes. So I think the first thing to think about is, when does this really hit us? This is so new, right? It really just started taking effect about 7 days ago. Mm-hmm. So you're really not going to see any of the repercussions of this until I think that first payment in April, right? People have already paid their rent for March, and now it becomes, how much, if at all, are we going to collect rent in April? And I think the narrative that the media is putting out there today, which is, hey, you're not going to get evicted if you don't pay your rent, is going to lead to a view out there that folks don't need to pay rent, right? Mm-hmm. So I think being proactive with your tenants, having a conversation with them today as opposed to later, saying that, look, we recognize this situation, but we're not going to of course tolerate things in situations that are okay. So I think the first thing is being proactive. The second is, everybody's asking, what sort of relief are we going to get from our tenants, right? I was on the phone with a good client, local client, that owns some mixed use stuff in town that has some very cool restaurant tenants, fitness tenants, salon tenants, like tenants that otherwise were operating very successful businesses, but beyond their own control have been forced to close down. So the first thing that I would go back to is managing the conversation with your tenants is, you might first recommend that everybody looks into business interruption insurance. Take a look at your current insurance policies and see what the language says based on business interruption insurance, because some of those businesses may be entitled to that, which might help bridge the gap a little bit. But finally, the reason that we had to delay this call a little bit is I was just on the phone on a conference call with our group internally with the head of NMHC, the National Multi-Housing Council, that advocates on all of your behalf in Washington. And what he's saying to us is that there is some sort of forbearance coming. It isn't in place yet.
Define what forbearance means.
That means no mortgage payments during the time of this affected period, or lenders required to work with borrowers over this period. So it's not out yet.
And is there any discussions on, is that only primary, like Fannie, Freddie, that kind of stuff, or is it secondary mortgages also and smaller banks that are not federally funded?
So we've already seen banks locally be proactive here and reaching out to clients saying, you can miss this payment. We'll add it back, at the end, and we'll work with you that way. We're seeing banks taking loan officers out of originations and focusing them on servicing the portfolio that's already in place. So folks are being proactive and talking to their borrowers and talking to their tenants. There is not a programmatic legislative initiative in place today that I can say no one needs to make their mortgage payment, but we have folks in Washington advocating on your behalf, and we'll be certain to circulate as much information as we can as quickly as we have it.
Yeah. So, I mean, one of the things that I've been doing, just so everybody knows, is like I'm shooting messages in a proactive, preemptive approach to my lenders, letting them know, here's all the things we're doing. We're clearly communicating with our team, with our tenants, with our vendors. We're taking all the necessary precautions to keep our places clean and safe and functional. And I'm letting them know that we're doing those things. And on the back end, I'm saying, hey, do you guys see anything? Are there any conversations going on behind the scenes of any sort of relief programs or any sort of access to business lines of credit that are going to be available in order to help small business owners, get past a lot of this stuff that's going on right now? So make sure you're reaching out, proactively reaching out to your lenders and to your banks and having these conversations now, and not when your back's up against the wall, right? So that's good stuff, Litzler. And you had talked about some of these lenders coming off of originations and now doing loan portfolio servicing. What does that do to new loans? What does that do to refinances? What does that do into acquisition loans?
Sure. So I would say that that's primarily on the bank side. That's just not as well staffed to handle the servicing requests. The life insurance companies, Fannie Mae, certainly the Wall Street money that's been securitized and has master servicers in place, those folks are well equipped to handle the servicing requirements that are inevitably coming. But I definitely do see a sort of wait and see mentality from much of the capital markets, many of our lender types, and that goes for a bunch of reasons. And I want to talk through first logistics, right? With travel bans inevitably slowed down and potentially more coming, with with third-party report providers not able to travel, with folks not able to get into units because folks are home. We used to do site inspections at 11 o'clock on a Tuesday, and maybe 2 or 3 tenants were home. Now 100% of tenants are home, right? So the challenges of closing transactions have really increased, and with that has become timing challenges. So if we used to close loans in 45 or 60 days, that's becoming 75. That's becoming 90 days. It is almost a certainty. So the first thing I would say when you're negotiating purchase agreements, when you're loans that are currently under contract, be proactive, over communicate, be on the phone with the seller, explaining the situation. We just want to manage expectations that timing is becoming more of a challenge. Second is are the results of that and the lenders that are in the market today. We have exclusive correspondent relationships with many life insurance companies. Life insurance companies forever have been the best source of long-term fixed rate capital, and many of them today are not in the market. And when I say not in the market, they are taking what I would call a pause from quoting new business. There is a very fluid situation happening in the capital markets right now. These things are changing by the hour. But pricing has gotten so out of whack so quickly that many of these lenders are saying we just can't quote new business at the moment. Now, how long does that go on? We think it's not forever, obviously. But what we're hearing is give us a week, or give us a few days. So we continue to monitor this situation, but several of our life insurance companies are out of the market currently.
So that's life insurance companies. What about and Fannie Mae and Freddie Mac and some of these other lenders? What are you seeing from them? Are they doing the same thing, kind of putting a pause on new business for now?
Well, I'll start with CMBS, and CMBS is a market that's pretty frozen right now because CMBS makes loans to be sold to bond buyers, and we're not sure where that market is or will be in 45 days when we sign up new loans. So the CMBS market, I would say, is pretty frozen at the moment, and we want to really caution folks that are either under app with CMBS or about to sign up loan CMBS, that the deal that you made 2 weeks ago, even 3-4 weeks ago, or even that's being quoted today is not the deal that's going to close at the finish line. You got to be working with a group that you trust, that is going to give you a market deal that everybody feels can make some money on. But the CMBS market is absolutely in flux today. So that leaves the agencies, right? So if we just talked about the other non-recourse fixed rate products that aren't in the market, well, Fannie, Freddie, HUD have a mandate to provide liquidity in the multifamily space, and they will continue to do that. We are under app on on a multitude of Fannie Mae, Freddie Mac loans, all of which we fully expect to close as applied. But new business is getting tighter. The reason being they are realizing that they are likely the only game in town. And when that becomes the case, the pipeline fills up very quickly. So what do they do to slow down the pipeline is to tighten credit standards, right? If we were getting 80% LTV with 5 years IO, that soon becomes 75 with 1 to 3 years IO. So the first thing they do is they tighten the credit box. The second is that pricing gaps out a little bit. We're seeing pricing across the board widen out significantly. If we were doing 10-year fixed rate loans with a spread of 210, that spread is 260. Still attractive all-in coupons in the mid to high 3% range, but
give me in layman's terms what that means. What is the interest rate on that stuff?
Call it 3.75% plus or minus 10, 15, 20 bips depending on any sort of circumstance.
So although interest rates, the Fed rate has gone to 0, right? And so as an example, prior to this, it was at, 150 or whatever it was, right? And the banks would want a spread of around 300 basis points, which would put the interest rate around 4.5%. Even though the rate went down to 0 now, you would think, the bank still only want a 300 basis point spread, so our interest rate should be 3%, right? That's not happening though. You're seeing that they're putting floors in, they're putting ceilings in, and then they want more of a spread. They want 350 or whatever. So really it's the interest rates haven't fluxed much. They haven't moved around too much. They've just fallen down a little bit from 4.5, maybe 4.2 is what I know we're looking at some stuff. Now it's in the mid to high 3s, right?
Sure. So this is a great question. I get asked it a whole bunch, and I want to keep it very simple because it's really tricky to get into how these things are priced. But there's two components of pricing. There's the index, right? Typically, long-term permanent financing is priced over the 10-year U.S. Treasury, right? And then there's another component, that's the risk premium. So that's what we call the spread. So 2 weeks ago, the 10-year U.S. Treasury dropped off a cliff down to a low of 40 basis points, the lowest ever, right? That yield on the 10-year U.S. paper has gone to 1.1% today in just a few days. So rapid increase in the benchmark. Mm-hmm. But then the other piece is the risk premium, and the risk of these loans has all of a sudden become substantially higher, right? So without getting into too much detail, and I'll kind of leave it there. If the spread used to be 200 basis points or 210, we're seeing substantial gap out in the risk premium. So even though your 10-year U.S. Treasury is still at a historically extreme low, you're seeing pricing widen out, which is leading to still attractive all-in coupons, just not as low as you would suspect with Fed funds rate at 0%.
Mm. Mm. And so rates coming down a little bit, not as much as we might expect. And at the same time, as far as terms for qualifying for new loans, you're seeing LTVs drop a little bit, right? You're seeing what else? A little bit less interest only, or a little bit, are they shorter terms overall, or can you still get 10, 12, 15-year terms?
So the duration of the paper's not changing, right? They get, 7, 10, 12, 15-year fixed rate money still fully available. But when you talk about reducing the pipeline, you talk about tightening the credit box altogether. So that's leverage, that's interest only, that's cash out, that's a bunch of ways to mitigate credit risk on the loan side. But then you got sponsorship credit tightening as well, right? So if the banks are still in the market, but they're definitely looking a little bit heavier on sponsorship, experience, balance sheet, durability, all of those things. And Fannie Mae, while they're non-recourse, they're certainly going to give a little bit better treatment to the guys that they view as well capitalized, more experienced, those sorts of things. So I think you're definitely seeing the credit box tighten and sponsorship getting, a little bit more scrutiny.
Dude, I think it's going to be, it's really interesting what's going on right now. And dude, if I'm a lender, I'm not making any loans when I know that you can't foreclose on anything. I know you can't collect rents or pursue evictions on anything like that's. It's just mind-boggling to me. So it's pretty amazing that Fannie and Freddie are still making loans and still pursuing that. But you're absolutely right, man. We're still very, very early, and this stuff's all changing by the day, by the hour, and there could be some sort of forbearance tomorrow. Who knows? Maybe tonight when the president gets on. But yeah, so a little bit tighter on rates, a little bit tighter on terms, a little bit tighter on qualifications, making sure that you got the net worth, making sure you got a little bit more liquidity, making sure that you have a little bit more experience. But that's a big opportunity for people who are qualified, right? What are you seeing as far as like deals that are currently under contract or sellers in the market? Have you seen some decent deals in the past week or two that have gotten inked just because of what's going on with this big scare?
No, I'm actually seeing more of a wait and see mentality from sellers at the moment. And I think a lot of the reason is some of the big institutional buyers are totally out of the market. As the stock market values have gone down, a lot of these pension funds or REITs are overweight real estate because as a percentage of their portfolio values. So that's taken out a large percentage of the buying public. We're still seeing family offices and some of the more nimble private buyers, in the market looking for deals. But as far as deals in contract go, I would absolutely reiterate my initial point, which is communicate with your sales broker and the seller about timing, right? Title closing, with the government offices closing and the third-party providers being backed up and not able to travel. Definitely, I reiterate my point about communicating timing.
For sure. What are you seeing as far as how about the different asset classes? So we've talked a lot about multifamily. What are you seeing in more like the warehouse and self-storage? What are you seeing in office and medical? What are you seeing in retail and hospitality? Is there anything going on in those other asset classes?
Well, I'll start with your last two because they're the easiest to answer. There is very, very little liquidity for the hospitality market right now.
Okay.
We're seeing occupancy levels just absolutely fall, off a cliff. we're seeing bailouts being proposed right and left. So there's really a wait and see on hotels and very little liquidity. There was a big deal in the market last week, and it basically got shelved until some of this stuff calms down. Single tenant retail is kind of a wide space, right? Like some of these, grocery anchored stuff clearly is doing okay, right? Because there's so much demand for grocery and pharmacy, but these multi-tenant shopping centers with the restaurant, the nail salon, what have you, there's a absolutely tougher market for that. A lot of that stuff was done CMBS in the past, and that market's froze up. So you're really stuck with recourse with the recourse life insurance companies or the banks. A couple other industries that are challenged at the moment would be seniors. Senior housing leverage is getting cut back. That's a tough space to be in right now. As well as student housing, right? Students, they're sending a lot of students home. So we're seeing seniors and student under a little bit of pressure. As far as office, industrial, storage, those markets we haven't really seen too much of an impact yet. I think time will tell. I think across the board on the commercial side, you will see tightening in the underwriting standards. So that's less leverage, that's shorter amortizations, trying to mitigate some of that potential risk. And then, but obviously on the multifamily side, we have the agencies that are mandated to lend on housing, and fortunately we've seen that market stay pretty strong.
So good news is multifamily, you're in good shape, right? Well, still
from a capital standpoint, we're in good shape. From an operating standpoint, we need to be taking the right steps to position ourselves for the future.
And what would you say? Give me a couple bullet points. You're an investor in a whole bunch of different properties. What are you hoping that your operating partners are doing?
First things first is let's communicate. It's one thing that I'm trying to do in my business is communicate with all my clients, right? We have a bunch of deals in closing at any one time, and just continue to have that conversation. My clients that maybe I'm not in the market with today, I think all want information. So we're just trying to be a source of information for all of our guys and gals out there, to be a resource to kind of help you navigate that. So I hope that same thing is happening from an operating partner standpoint. Two is we hope that they're well capitalized, right? Because in a scenario where rent isn't collected, operating expenses still need to be paid. So, we're doing a lot of due diligence on the front end, making sure that our borrowers are well capitalized. Fortunately, and I can speak to Tim's platform, debt service, a lot of the challenge becomes debt service, the debt service payments. Well, I'm intimately involved with his capital stack, and on virtually every deal we fund an interest reserve up front. So a lot of that stuff is mitigated when it's been well capitalized on the front end. And those are really the two points that we're seeing. I think April 1st will be a really telling sign, and I would say make sure you're communicating with your property management folks on the 1st, on the 3rd, on the 5th, on the 7th to see how collections are coming in, so we can continue to monitor that sort of information.
Yeah, 100%, man. Good stuff. How do you set up, and this is probably gonna be one of my last questions, how do you set yourself up as an operator to not only not lose, but to win, right? Like, what are the best things that operators can be doing right now to set themselves up for success once we get out of this? Like, I'm a believer. I don't think this is this isn't a 2008 global financial crisis, right? I don't think this is like some systemic collapse of the economy. I think this is more of like a 9/11, right? Like a fluke type catastrophe type incident that occurs. It makes everybody very scared. People pull back for a little bit, but you come back out of it in a pretty quick manner. At least that's kind of what I'm seeing, and what a lot of my mentors and stuff in business and in real estate. We have pretty parallel thoughts on a lot of that. So what are you seeing? What are the best things that people can do in order to set themselves up for success? Because I do feel like this is going to thin the herd, right? There's going to be a lot of people who fall out over the course, who don't have the liquidity, who are not communicating, who end up having to give properties back or fall out of the real estate industry altogether. How do you make sure that we talked about how does it not happen, right? Now, how do you make sure that you're able to prosper on the back end of this thing? Because I truly believe, man, there's going to be fortunes that are made. Decamillionaires, centimillionaires, billionaires coming out of this in the next 12 to 24 months.
Sure. So I think what you saw with guys that were in this business in 2008, in other sort of times of hardship, that's where relationships were really cemented. So I would make sure that you're communicating with your investors, with your lenders, with your property management folks. Just let them know that you're there, that you're not avoiding the difficult conversations, that you have their back, and that we're all a team on this, and we're going to get through this together. So I think that's the first thing, is just don't avoid those difficult conversations. Make sure that your team is that your team is communicating, and that we have a plan going forward. The second point that is kind of controversial, but I think is something that is my personal opinion, is I would conserve cash today. If you have value add projects going on right now, and you're maybe fronting that cash, I might wait 2 weeks before I execute the next round of turnover, just to see how long this sort of event takes place. That's just my personal opinion. Now, if that capital is sitting in the escrow account and it's earmarked for CapEx, go ahead and do those projects. But if you're front loading, if you're rehabbing out of cash flow, I would probably sit tight for a couple weeks to see how long this thing plays out.
That's exactly what we're doing. Until if we have 4 vacant units at a property, 2 of them are rent ready, 2 of them are not rent ready. We're leasing up those 2 that are rent ready before we do any renovations on those other 2, just to conserve a little bit more cash.
And 3 is maybe a less talked about item, but I would pay particular attention to your bookkeeping in this time of uncertainty, because fast forward 9 months from now, hopefully we're out of this thing, but we want to make sure that we can really pinpoint back and explain this inevitable dip in collections. Just say, hey, this was our general ledger at the time. This was our accounts receivable, just so we can show a very clear path as to why performance dipped at this time across stabilized properties, across value add properties. Just make sure that we're paying particular attention to the bookkeeping, and we'll be able to easily explain this dip perhaps 8 years from now, right? Or 8 years is probably too long, but 2 years from now.
For sure. So I know we've been talking, like the phrase of the week has been inspections and collections, right? If you got deals in the pipeline, let's get them inspected. Let's get the appraisals out there. Let's get the on-site inspectors out there. Whatever needs to happen, all the third parties, get all that stuff done. Push that along in case there is some sort of a quarantine or a further limitation on travel and being out in the public. So that's number 1. Number 2 is collections. Exactly what you just talked about, Chris, is just focusing on making sure the collections are still coming in. And so one of the things that we're doing, we're communicating heavily with our tenants, and being friendly in an approach, but also firm, right? And making sure that they know that we cannot pay our bills. We cannot support the building from a maintenance standpoint and all these things unless they're paying their bills as well. And so not telling them that, hey, you better pay rent or else, right? Because at the end of the day, that never works, right? You start getting friction in that regard. But we're having conversations with them and saying, hey, here's why it's so important to pay rent. Here's why it's so important to do this, because then we can keep the place clean and safe and functional. And we're setting them up with different types of platforms and programs, and whether that's unemployment support, whether that's some sort of a rental assistant type program, and communicating with whatever that stuff looks like in order to get them the money that they need. And hopefully if they get that money, hopefully they pay rent with it, right?
Yeah. So the only other point that I would make is if you haven't been in, if you don't have a good relationship with your tenants, and this is mostly on the office, commercial, warehouse, industrial side of the house, but now is not really the time to start the relationship with your tenant, right? So, we want to be communicating now, but hopefully we have been communicating in the past, because times of hardship aren't really the time to start the relationship. So at least if you haven't been doing that, make sure you're doing it now. And then we can use this as a learning experience going forward to make sure that we're always communicating with the tenants, good news, bad news, or just somewhere in between.
Right. Good stuff, man. Anything else that I missed? Anything else that we need to hit on?
No, thanks again for having me on. And, to the extent that that anybody listening to this has questions, you guys know how to get a hold of me, and we're happy to, we're working around the clock to make sure we're keeping everybody informed and closing the transactions that are in the pipeline.
No, man, that's good stuff. Well, I appreciate you, dude. Thank you for all the insight and all the knowledge that you've shared here, and obviously offline with me as well. And yeah, hopefully everybody stays safe, stay communicative with everybody, your lenders, your mortgage brokers, your tenants, your team, your vendors, everybody that you're doing business with. And I think, we'll ride this thing out together. It'll all work out. We're all in it together. We're all going through the same struggles and hardships and uncertainty and unknowns. And, make sure that you're getting liquid, make sure you're focused on moving the needle forward, regardless, and make sure that you're focused on collections, right? Generating revenue and making sure the revenue comes in so you can still keep on paying your bills and stuff too. So, good stuff, buddy. Well, I appreciate you.
All right, bro.
We'll probably be doing this again by Monday. So just a heads up.
We're available. Thanks, buddy.
Appreciate it, man.